Oke ya, karena memang one of the yang paling menarik adalah, eee, our interest and
Mhm.
also apa ya, ya bisa dibilang panggilan kali ya,
Ya,
calling kali ya, itu emang education gitu.
teaching kan?
Teaching
Ya,
ya,
I like teaching and you like
I like
teaching tuh.
teaching ya. Jadi cuman mungkin emang beda topik
Ya,
and beda approach.
beda approach.
Beda approach. Cuman one of the apa ya, bisa dibilang common goal-nya adalah emang education gitu.
Yap,
Jadi makanya it's very nice, bisa I think work together
yap,
supaya karena emang visi misinya juga arahnya ke sana.
ya. Jadi itu project yang kita udah plan sih dari
Mhm.
berapa 2 bulan lalu ya.
Yeah, I think around that time ya.
Jadi 2 bulan lalu sempat ketemu juga ya kan, kita bahas gimana caranya kita bisa improve pendidikan Indonesia gitu kan.
Mhm. Iya.
Tapi malah ya begitu kan, orang kan ada yang FOMO kan langsung.
Ya 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 ya. Tapi memang apa ya, eee, the banter emang it's apa, our common goals emang ke sana sih gitu.
Oke. So where do you see like Indonesia kalau misalnya edukasinya
Mmm,
dibenahin menurut lu, can this be something yang membantu negaranya?
yep, definitely ya, karena I do believe that our biggest hope is in the future
Ya,
generations. Apalagi ngeliatin nggak usah jauh-jauh yang sekarang masih kecil banget ya, tapi
ya,
liatin generasi adik-adik, eee, like my brother masih Gen Z sih, cuman like the younger generations, Gen Gen Alpha gitu. They're so quick to, absorb information,
oh iya ya cepet
ya
ya.
cepet banget. Terus mereka semua yang apa ya, cara mikirnya udah out of the box banget gitu.
Ya,
Jadi, pastinya mereka jadi harapan buat generasi buat negara and also our world as a whole karena mereka yang akan lead the apa ya, the generations after them juga kan.
bener.
Jadi makanya, eee, I feel like what I can do as someone yang pernah memang satu, I was exposed as a kid in front of the media dari kecil and then
Oke.
udah ketemu banyak anak-anak lain juga and then see the world tuh dari kecil maksudnya how education shape children segala macam dari kecil and then growing up ngelihat juga banyak orang and then I took neuroscience juga specifically which is catered towards learning about humans brains. I feel like what I can do as someone yang punya background itu adalah mencoba untuk memaksimalkan itu semua supaya the next generations at least ambil hal baik yang from what I got,
Oke.
um, and implement that ke mereka supaya apa ya, ibaratnya kalau misalnya ada kesalahan yang pernah dilakuin, at least let's say from educators towards me or
Ya,
towards my friends segala macam, we can minimize that gitu. Jadi karena I know the research juga, and I feel like banyak juga experts di luar sana yang tahu the research. I feel like we can try to implement that to make sure the growth of the future generations lebih apa ya, lebih baik lah dibanding generasi kita.
ya karena sebenarnya kenapa aku juga pengen bikin ini karena waktu itu udah semi hopeless sebenarnya sama generasi. Yang mereka suka tuh bukan sesuatu yang substansial, mereka kalau misalnya kayak begini mereka nggak suka.
Hmm,
Tapi kalau misalnya drama atau gosip mereka paling cepat. Karena sebelum sebelum aku tutup ya mungkin ya.
ya.
Apa yang kalian lihat di sosial media itu mungkin 1% Cel, dari apa yang terjadi di balik layar atau sebenarnya terjadi. Jadi menurut aku nggak fair kalau orang tuh mau coba untuk narik kesimpulan
Hmm,
itu di hal-hal yang mereka nggak tahu
hmm,
gitu. Mereka coba ngelabelin orang, mereka coba nge-framing orang yang mereka anggap sepele sebenarnya. Tapi mungkin buat orang lain nggak sepele. Menurut mereka tuh cuma satu komen kan di timeline kan habis itu komen yang lain lagi. Oh si ini begitu, sini begitu. Jadi itu salah satu yang kita pengen educate juga ya
hmm.
untuk orang nggak begitu. Nah mungkin as a closing statement ada nggak yang mau ditambahin mungkin dari neuroscience part why orang begitu biar mereka sadar mereka jangan begitu lagi.
Hmm.
Ini member Grab Unlimited. Member mau jalan, member mau jajan, member remember. Hematnya nggak kelar-kelar, forever and ever. Yuk jadi member.
In construction, it's important that we can use our tools on the go. Adobe Acrobat gives me the power to quickly edit text and add freehand markups into our PDFs, all from my tablet.
Kayaknya mungkin yang suka orang, salah pengertian tuh banyak yang berasumsi apa yang kebanyakan orang lain itu bilang iya itu yang benernya. Padahal belum tentu kebanyakan the opinion of the most itu the valid ones.
Yeah.
Mungkin itu yang one of the apa ya? Yang emang bisa dibilang lagi our emotional brain is very powerful and we'd like to conform to the norms. Jadi itu very normal sebenarnya. Cuman what I can say to people out there and also to remind myself adalah bukan berarti semua hal yang ada yang kita lihat and then the most things yang kita merasa benar itu benar. Jadi
Yeah.
makanya always do a cross check and realize that our emotional brain is super powerful and then balik lagi karena tadi cognitive resource kita itu ada limitnya. Make sure we allocate that to things that actually matter. At least
Okay.
that's for me ya. Kayak maksudnya karena sayang banget kita punya attention segini, punya energi segini kalau misalnya dialokasiinnya ke yang salah. Karena sebenarnya ini from in my point of view ya. I feel like everybody can achieve so much sebenarnya. We are given the space and then the opportunities to do so much sebenarnya. Tapi kadang yang jadi salah adalah the way we allocate it and then the way we pay attention itu salah. Jadi makanya make sure you know what you're paying attention towards and then allocate your energy ke gelas-gelas yang benar.
Ya, jadi buat oknum-oknum jurnalis ya jangan kebanyakan nyinyir. Ya, bagusan fokus. Gue udah kayak Hotman nih, nyinyir ya. Udah ketularan tadi udah mau begini gue. Jangan kebanyakan nyinyir ya. Kalau misalnya nulis sesuatu itu harus berdasarkan landasan kan. Nggak boleh sembarangan gitu. Jadi
Yeah.
jadi jurnalis nggak bisa sembarangan.
So mungkin ini ya, kalau ini yang mungkin one of my concerns juga. Kadang tuh karena kan sebenarnya sebagai manusia salah satu needs kita, tapi ini yang paling atas sih. Kalau ada Maslow hierarchy of needs, yang paling atas tuh kan self actualization.
Yep.
Kan. Sebenarnya semua orang tuh pasti punya purpose, punya panggilan. In my opinion.
Ada yang punya panggilannya pengen ngerusak hidup orang terus gitu.
Sebenarnya ini tapi dibalik lagi semua orang punya view beda-beda.
Yeah.
I like to think that people are naturally good.
Oke.
That's my view seperti itu. Kayak sebenarnya orang tuh semua baik. Cuman ya yin yang lah, yin yang. Maksudnya
Yakin Cel? Orang pada nature baik. Kalau gue punya view yang completely different.
beda ya.
Iya.
Kalau in my opinion sih baik. Pasti ada alasannya. Kenapa? Ya itu yin yang. Pasti ada di putih kan pasti ada hitamnya.
Iya.
Di hitam pasti ada putihnya gitu. Jadi pasti ada alasannya kenapa. Nah, I guess what I can say, what I can add adalah if you find your purpose, I feel you wouldn't, karena kan jadi ada sesuatu yang pengen dituju.
Oke.
Jadinya
Ada North Star-nya.
ada iya kan, ada North Star-nya, kita pasti we're gonna look up, right? Kita nggak akan busy ngurusin yang di samping-samping.
Ya, jadi jangan sibuk urusin hidup orang, urusin hidup lu sendiri. Itu aja ya.
Ya.
Bye bye.
Oke.
Kita baru bikin lagu ini bagus banget.
Panggungnya di fanbase langsung.
Gimana bang cara nguploadnya bang?
Fall in love dengan rasa Cadbury.
Ela tá cheia de tesão, eu vou te fuder com amor. Mina linda, safadinha, arregaça esse popô. Vai.
jet was forced to abort landing to avoid a mid-air collision with a B-52 bomber. The incident happened last week in North Dakota near an Air Force base. Citing the pilot, ABC News reported the plane had to make an aggressive go-around maneuver as the other aircraft became visible. ABC News also says that afterward, the pilot apologized to passengers. And President Trump is threatening to block the Washington Commanders' bid to build a new stadium in D.C. The president says he won't make a deal unless the team changes its name back to the Redskins, a term considered offensive to Native Americans. But Trump claims there's a big clamoring from them to restore the old name. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day and a week ahead. Plus, we'll catch up with Chris Harvey of Wells Fargo with the most bullish S&P 500 target on the street. That conversation up next.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
I don't see 10-year yields at 5%. I think they belong at 5%. And that's the great puzzle, that they're not there. That's telling us that there's constant demand for government bonds. There's constant demand for the bond market out there. Every time I meet with investors, they're trying to figure out where to get into the bond market.
Bob Michael of JP Morgan Asset Management on the program a little bit earlier this morning. In the market right now, equity futures positive, bonds are too, yields are lower. Futures are up by 0.2%, and your bond market looks like this: 2s, 10s, and 30s. Your 30-year yield is south of 5%. We're down 6 on the session to 492. Your 10-year is 436. Bob Michael's saying, I don't see the 10-year at 5%. He sees reasons that they belong there, but he doesn't see them getting there.
Which shows the incredible bid for bonds and how globally there's this incredible demand. I would argue that what we're seeing today is a bit of the Japan effect, and how we're getting whipsawed by the fact that it's not as bad as it could have been, with sort of fiscal irresponsibility, potentially maybe on the Japanese side. But, you know, he's making an argument for bonds. Let's see what happens if the Fed cuts by 50 basis points.
You think the Fed cuts 50 basis points?
No, I don't think so, but I'm saying that what happens...
Worth exploring that.
Like, just basically counterfactual on this Monday morning.
If they went 50 next week, for instance, what would happen to the long end?
It would probably... You'd see yields up, you'd see price down in a significant way, and it would raise questions about independence.
Which is what we saw at the back end
Correct.
of last year. Futures this morning then, just about positive by 0.2%. The bond market doing okay. Thank you, Japan. According to Lisa, Japan in the driver's seat in many ways over the past few weeks in fixed income worldwide. That's the price action. Your week ahead is shaping up as follows. Coming up a little bit later in the week, we'll hear from Fed Chair Jay Powell speaking at the FOMC's regulatory conference. On to Wednesday, results from Tesla and Alphabet. On Thursday, a rate decision from the ECB and earnings from Intel and American Airlines, plus another round of jobless claims. And then on Friday, going into the weekend, durable goods. Let's stay on the market. Stocks trading near all-time highs. Chris Harvey of Wells Fargo, the most bullish man on Wall Street. S&P 500 price target of 7,007, and he joins us now for more. Good morning, Chris.
Good morning.
You uncomfortable with that? I want to give you some credit before we start. Credit to you for not changing this call in the tariff storm of early April. So let's start there. Why did you stick with it?
So 9 months in the financial market, that's an eternity. The other thing, we had seen Trump 1.0. We know his style. It's to go out to the nth degree and then to come back in. Furthermore, the underlying fundamentals were still fine, and our EPS and our price target wasn't predicated on a strong economy. What we're seeing is the winners continue to win. The Uber cap companies have the higher margins, are gaining more market share. There is a real secular trade in AI that will continue. I was here during the 90s. This is not a fair comparison. It is much stronger, and the fundamentals are much better than today than they were back then.
7K is not tariff dependent. It is not August 1 dependent.
No. So people ask, well, what's the fear? The fear is, there's a couple fears. One is, do tariffs start to flare back up? And that's possible, right? We just can't predict that. The other fear, which is a much more real fear, is what's happening with the Fed. Do we worry about the Fed and confidence in the Fed? Because the back and forth between the Fed and the White House, that's not healthy, right? And that can cause problems in the bond market, and that can cause problems with confidence. But overall, we're starting to see M&A activity kick up. We think that M&A will continue to be very, very healthy up and down the capitalization. We do think the Fed's going to cut. Fundamentals are fine. The consumer's okay. And we're not seeing the kind of price increases that people are talking about. We're seeing people say surgical when they're talking about price increases, and selectively.
So there's a lot to unpack there, and we'll get to the Fed independence in just a second, and what point yields have to rise to before that really triggers some sort of response in equity markets. What about valuations? The idea that you're talking about an 11% gain from where we are right now on the S&P 500 after already reaching record highs amid a wall of worry and, frankly, growth that is expected to slow.
Right. So we talk about this all the time because people say, oh, look at 20 years ago, look at 25 years ago. The S&P is not the same as it was 25 years ago. The constituent of the S&P 500 is much more growthy. It's much more techy. The multiples are much higher. The productivity is much better. The people running the companies are much more attuned, and the acumen is much higher. And so the valuation, yes, it's high, but it's justified in our minds. And again, we don't need to see a whole lot of multiple expansion to get to that level. We're not very far from that level at this point in time.
So valuation concerns don't really you don't spend a lot of time on those. I do want to go to the Fed independence side, though. There is a question of what point yields have to rise to before it triggers true concern in stock markets, because we've asked that question many times. People give us a level, and then we pass that level, and stock markets shrug it off and say, healthy, healthy, good.
Yeah, it's hard for me to really answer that question. I think what's happening right now is you had Trump come out and say, I'm not going to fire Powell, right? And I think he needs to go out and say that, right? There's a lot of talk and rumors and situations in the marketplace. At the end of the day, we need the Fed. We need the Fed to be independent. We need the Fed to be apolitical, because it is a very important part of our marketplace. And as long as we can do that, that's great. I don't know if rates really have a play in this. I think it's just cooler heads need to prevail.
You read Trump correctly when it comes to tariffs. He put out a truth over the weekend about what Bessent potentially laid out to him when it comes to the market impact of firing Bessent. People don't explain to me, I explain to them, says the President of the United States. Did you take that as him basically acknowledging he understands the negative impacts that could have on financial markets?
I think his team understands. I think he understands. I think if you go back, and one of when we were on the show a while ago, we were talking about, will the feedback loop close, right? Will the administration see what's happening in the capital markets and react to that? And they did. So I do think they understand, but I also think that he feels like he's playing with a very strong hand, and to a certain degree he is. And one of the things we are beginning to worry about is he's looking at tariffs as a revenue generator, right? We have what we have with the deficit, and saying, hey, this could be a good way to reduce the deficit. We haven't seen the real impact to the economy. What's the big deal?
In that same truth, he said if it weren't for him, the market wouldn't be at record highs right now. But if it weren't for him, would potentially already be at your 7007 mark.
Yeah, there's a lot of speculation on speculation there. I think we could have done this. Talking my book, one of the things I said, and one of the things I believe is you could have put a 10% tariff on and then just walked away. Right? We talked about how there was a seller's tariff and how people, whether it's through Airbnb or Amazon, they understand it. You had Congress put that 10% tariff on, walk away, and we can do something more productive. But we chose this path, and it's okay. It's a little bit bumpy, but we're getting there.
Might get bumpier. Peter Schiff of Academy. Without the markets pressuring the administration, why would they pull back going into next month?
Well, this to me is the key question. How much is this administration playing chicken on tariffs with the market? If the market's looking past something that hasn't happened yet, does that push them to potentially go even harder because they could extract more that could offset the deficit concerns from the one big beautiful bill? And there we go.
And you see these countries lining up to really want to do deals and getting a little bit nervous when you have Howard Lutnick, the Commerce Secretary, coming on Sunday shows saying August 1st is hard to stop deal. Also, he's already telling us what to expect next year. He said, of course, we're going to renegotiate USMCA so we could prepare for more headwinds in terms of Canada, Mexico, and the United States.
It's going to keep coming. It's going to keep coming. Chris, just to wrap it up, the US versus the rest of the world. What have you made of that debate over the year so far?
So we thought that was possible. We thought that was probable early in the year. It happened. Now we're just walking away. We just don't. We're done. We're good. You had that repricing. Now let's go back to fundamentals, and the fundamentals are telling you back to the U.S., back to growth.
Chris Harvey of Wells Fargo. Appreciate it, sir. Thanks for being here. It lasted how long? 5 months? 6 months?
Always a tourist in Europe. That seems to be what it is, whether it's markets or whether it's otherwise.
That's beautiful.
Thank you.
You should frame that. That's a fantastic quote.
Well, I mean, that's sort of how it feels to me. And people sort of get excited about the prospects of growth, and then they head over there and experience the regulation and some of the other hang-ups with certain labor market structures, and then they come back here. And that's been what it's been going on for a while.
Always a tourist in Europe. Bramo. July 21, 25. Coming up tomorrow, Man Miskin of Manulife, John Hancock, Russ Brownback of BlackRock, Dan Niles of Niles Investment Management, Andrew Hollenhorst of Citi. From all of us, thank you for choosing Bloomberg TV. From New York City, this was Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to
continue to contribute to the growth of US as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the US. And US is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates a complementary diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
In case you missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Jumana Bersachi in Vienna, and this is Bloomberg.
Futures edging higher this morning ahead of a hefty earnings week. 30 minutes until the official start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, big tech on deck. Investors bracing for a busy earnings week that includes results from Tesla and from Alphabet. Meanwhile, Invesco wants to break open its QQQ piggy bank. Wall Street calling it a game-changing event, and the IPO market heating up as Figma readies what could be one of the biggest listings of the year. All of that and more coming up in the next hour. But Sonali, let's get a check on what's moving under the hood right now.
Green on the screen for the big tech firms ahead of those earnings. Huge earnings week underway. The first set of Magnificent Seven stocks reporting. Wednesday, you have Tesla and Alphabet, both stocks still down on the year, Katie, but up pre-market. Intel, too, up about 0.9% as investors await more news.
So that to come. Verizon kicking us off this morning on this earnings week, posting a surprise net loss of subscribers, but it raised its profit outlook, citing President Trump's tax bill and wireless price increases. Let's break down these results with Bloomberg Telecom reporter Kelsey Griffiths. So talk us through the fact that this was a beat and raise, but at the same time, they actually lost subscribers. Was this all due to price increases?
Yeah, so a word that you hear used to describe Verizon often is disciplined. I was just listening to the call with investors a few minutes ago, and the word discipline was coming up a lot. So I think what we're seeing here is this sort of mixed approach that Verizon is taking. They have been investing in a lot of aggressive promotions in the last several months, in the last quarter, in order to sort of catch up with some of their competitors that never stopped running promotions after the holiday season. But we're also seeing that they're not going to do that at the expense of other financials. So we did end up seeing their revenue doing really well, and we saw them raise their full year guidance on several metrics.
Well, part of that was due to what they said was favorable tax reform. When they're raising their guidance, how are investors absorbing that impact? Are they seeing this as a one-time gain, or is this something that could be more sustainable and have a ripple effect?
I think we're still hoping to hear a bit more from Verizon on what their outlook is there and how they hope to apply these favorable tax benefits. But generally, this usually looks like more capital to invest. And again, I think we're still waiting to see what they're going to do with that additional cash. we do see that Verizon has been investing in growing their fiber footprint, and they are waiting on the Frontier transaction to close, which will give them a lot more reach into that broadband market.
Kelsey, we thank you so very much. That is Bloomberg's Kelsey Griffiths. And coming up in the next hour, we're going to be joined by Verizon CEO Hans Vestberg. And it's a big earnings week for big tech and the Magnificent Seven, Alphabet and Tesla. As we've been talking about, report on Wednesday with growth tested by economic headwinds and mixed earnings results from the other big players in AI. We're going to get the details now with Bloomberg Technology co-host Caroline Hyde. And there you see it. You have these two stocks that are down year to date, one more significantly than the other.
Yes.
When it comes to CapEx, how is this going to set the stage for the rest of how investors will perceive the Mag 7 results?
Well, when you're thinking CapEx, you're likely to see Bloomberg Intelligence thinking Alphabet's going to up it, maybe 10 to 15%. This is where the margin hit comes because they're fighting for AI talent. They are making these sort of weird acqui-hires that we've just seen being done with the likes of Windsurf with Alphabet, and they're having to explain the bang for the buck. Alphabet, you're likely to get it. Google is still managing to increase the cost of ads. You're likely to see a really good, then healthy number coming from ad search in particular. AI overviews has won out really well for them, so they're likely to price more against that. So you're likely to see revenue up about 12%. You're seeing earnings per share growth for Alphabet, even though, as you see from the share price so far this year, it's been a relatively unloved stock compared to the rest of the Mag 7, because in some ways it's seen as like an AI also ran, whereas really it needs to pack the punch that it's an AI winner. Whereas Tesla, I mean, boy, we know the deliveries have been ugly.
Right. We certainly do. And I'm thinking about Miller somewhere in Italy, thinking about that as well. I will say with Alphabet, I'm interested to hear about Waymo as well. That actually has the largest footprint of any robo-taxi operator in the U.S. That's one of Tesla's big bets. I'm interested to hear any update we get on the planned expansion there.
Well, when you think to Waymo, operating profit, it's not going to be dialing us up much overall. But yes, it is managing to, in the other bets department, probably drive up revenue by about 12%. They have scaled, they've showed it work. When you look at robo-taxis, this is where the proof needs to come in. Maybe we don't care the fact that revenue is going to sink yet again. The earnings per share is going to be down about 40% yet again for Tesla. Because Elon Musk, if he come out fighting, if he can come out and say, as he already is on X, I'm sleeping there, I'm there all day, every day. This is, you know, manic mode for him in particular. We are likely to see, therefore, maybe him galvanize his retail investor that, yes, the investments on robo-taxi future. Remember, he's promised it not going just to Austin, where they've only got a handful, 10, 12 cars. It's going to be in San Francisco in the next month or two. They've got their new futuristic diner. Don't know if you've just seen that opening in LA, Cybertruck boxes for the win. But this is all about marketing and trying to convince people that the amount of money that he spends on his data centers and indeed on more broadly the robo-taxi push out is going to be worth it in the longer term.
I'm glad you brought up the post that he made about sleeping in the office when he doesn't have his little kids with him. He posted that on Saturday. The shares are up a little bit this morning. A lot of people posting or pointing to that post because that's what shareholders really want. They want him focused on Tesla.
They want him back in the CEO role, focused purely on this. There's also, of course, we're questioning about the money going from Peter to pay Paul. Yes, they're going to ask Tesla shareholders longer term whether they want to put money into XAI. What is the dividend of doing that? Why does Tesla shareholder want to see money put from their own money pots into the future of large language model building for XAI? Well, because it feeds into robo-taxis. It's already going to be useful within Tesla. It's ultimately about really brand Elon once again. We know how much he can shake off anxiety by just saying he's back in full force, and certainly is trying to signal that on X. The question is whether they're sleeping overnight is really going to pull out some of the sales and deliveries. Juniper Y, the new Model Y, the updated Y, is likely to have done relatively well. But remember, we're going to see a bit of a pull forward because of that pullback on the tax credits that you're likely to see by the end of September. People are going to race to get their cars ahead of that 7,500 coming off. But then what about the energy business? That's been a real winner for them. We'd like to see 50% growth, but is that going to go forward now that we know that the administration and the tax and the budget bill is pulling back from those sorts of subsidies and credits?
All right, Caroline, you have a busy week ahead of you. Great preview.
Don't remember IBM Wednesday too. It's going to be fun.
International Business Machines.
Busy
How
2
could I
weeks.
forget? Yeah, it's we're really in the sprint season here for big tech earnings. That is Caroline Hyde. She is the co-host of Bloomberg Tech. You can catch her at 11 a.m. But speaking of Tesla, automakers also releasing results this week, and you had Stellantis posting a brutal first half with a near $3 billion net loss. Restructuring expenses, waning sales, and U.S. tariff impacts all played a role in the prelim results. Bloomberg's Craig Trudell. He leads our global autos coverage. He joins us now. And Craig, I mean, I guess it's not surprising when you think about all the different cross currents coming at automakers right now, but still, some of these numbers, specifically with Stellantis, are pretty eye-opening.
Yeah, I mean, we just talked about, Tesla and the EV outlook is very mixed right now as a result of some of the changes that we're seeing the Trump administration make. And that was one of the factors that you saw. Stellantis site here is essentially doing away with some product programs related to EVs and the undermining of the fuel economy standards in the U.S. You would think on the surface that would be a positive thing for Stellantis. They sell an awful lot of big Ram pickups and Jeep SUVs, but this was a company that was trying to really transition to an electric future and having real trouble doing so. So you have a real challenge and issues with making that jump, and sort of pullback by the company that this may come as some relief a year out from now, but for the time being, this is a lot of churn in their spending, and they're going to need to do some sort of taking of charges related to money already sunk into some of these bets that they're now going to have to take off the table.
Craig, we appreciate you keeping an eye on all of it for us. That is Craig Trudell of Bloomberg News. Now, more movers on our radar. Katie, you caught this one. Block is surging after news that it will replace Hess in the S&P 500. Of course, Hess closing that merger with Chevron, and Block was down about 14% this year. It's recouping a lot of that this morning.
Yeah, big time. A nice surprise there for Block. Shares rising mightily when you think about all that passive money that might come into it. Domino's also on the rise this morning. It topped sales growth expectations. Shares up a neat 4%, and I'm really excited to talk about Invesco. Invesco, it's a little bit higher this morning. It was up 15% on Friday, Shonali. That was its best day since 2022. For a really in-the-weeds reason, it filed to turn QQQ, it's their famous tech fund, from a unit investment trust into an open-ended ETF. I swear to God, that's exciting because
I read your newsletter on this.
Thank you.
It's a Monday, but still read her Friday newsletter because it does have a lot of details on why that matters.
Yeah.
Money, a lot of money.
A lot of money, potentially hundreds of millions of dollars for Invesco that they currently don't collect. But we'll be talking about that later on in the hour. But coming up next, I'm pleased to say, Research Affiliates founder Rob Arnott, he joins us to break down a huge opportunity he sees in value stocks. This is Open Interest.
Calon-calon tablet recommended nih. Ini Xiaomi Pad 6 yang dikasih steroid. Nah, walaupun ngebawa-bawa nama Xiaomi Pad 6, tapi secara experience ini beda banget. Performance-nya itu ngelunjak cuy. Kalau kita lihat dari benchmarking-nya, itu multi-core naik sampai ini juga udah pakai HyperOS. Lihatnya, gua sandingin juga keduanya dengan brightness tertinggi dan emang lebih terang.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
And now to high interest, a look at what's making headlines around the world. Taiwan Semiconductor's market value closed above $1 trillion for the first time last week, driven by robust artificial intelligence demand. The stock surge reflects growing investor confidence that the world's top chipmaker will ride the AI boom to even greater dominance. And the biopharmaceutical company Sarepta is refusing to pause shipments of its medicine for a deadly muscle-wasting disease, despite a request from the FDA. 2 teenage boys died of acute liver failure in recent months after taking the treatment. Sarepta has lost about $8.5 billion in value since March 18th, when the first patient death was reported. And Microsoft servers have been hit by a large-scale cyber attack, with hackers exploiting a security loophole in the company's SharePoint systems. The Washington Post is reporting that the breach affected U.S. federal and state agencies, universities, and energy companies. And Katie, you do see Microsoft shares down almost 0.7% pre-market.
Yeah, a little bit of a drop there in Microsoft. We'll continue to follow that story. But let's zoom out a little bit and take a look at the broader universe, because our next guest says that historically cheap value stocks are screaming opportunity as growth stocks get the spotlight. Rob Arnott of Research Affiliate says that, quote, if the value is dead narrative is even slightly wrong, value should perform brilliantly in the coming decade. Exactly the same argument can be applied for U.S. versus non-U.S. stocks and for U.S. large cap versus small cap stocks. I'm pleased to say that Rob joins us at the desk now. It's great to see you in person.
Wonderful to see you.
So I know you like asymmetrical bets. When it comes to value versus growth, it seems like, as you said, even this being slightly wrong would translate into big opportunity for you.
Yeah, the markets prices are set based on narratives. The narrative is that the Magnificent Seven will alter our world beyond recognition in the years ahead, that these companies will own the future, and that the owners of these companies have nothing but prosperity ahead. Narratives have the advantage of being largely right. These companies are going to rock our future. Shareholders in these companies are participating in that revolutionary change, but it's already in the price. And so that means if any of the seven were to fall short of expectations, the consequences can be unpleasant. This is how the dot-com bubble burst. The folks who coined the expression Magnificent Seven clearly never saw the movie. 4 of the 7 are dead at the end of the movie. And so do I want to pick which 4 of the 7 aren't going to be stellar in the coming decade? No, I do not. I want to look elsewhere for opportunity. And this is an opportunity-rich environment. I've been called a perma-bear. I'm a bull on things that are cheap and a bear on things that are frothy.
Well, let's talk about where value is working. We were looking at this chart this morning, and I thought I was hallucinating until Shonali reminded me that we're looking at the small cap universe. If you compare Russell 1000, we have the Russell 1000 value index. It should be the Russell 2000 value index versus the Russell 2000 growth index over the past several years. We'll get the chart up. But anyway, in the small cap universe, you do have value stocks outperforming growth stocks mightily over the past 5 years. And I think a lot of people would be surprised by that. But does that just come down to the fact that you don't have those Magnificent Seven tech stocks or anything like them when it comes to the small cap universe?
The narrative takes hold when companies get noticed, and they rarely get noticed when they're small cap. So what we find right now is that Russell growth, for instance, is at nearly twice the valuation multiples of Russell value. Russell large cap growth is nearly 3 times the valuation multiples of Russell small cap value. And these spreads are at historic extremes. So looking at large cap growth versus small cap value, the spread is wider than it was at the top of the dot-com bubble. It's wider than it was at the trough of the COVID value meltdown in the summer of 2020. These valuation spreads are huge. Now, the narrative is, forget value, these companies are toast, or many of them are. Here's a simple fact a lot of your viewers will find utterly shocking. The earnings for Russell 1000 growth have grown over the last century to date by 1% per year faster than the earnings for Russell value. 1%.
So what does this mean? Does this say more about the small cap universe than it does say anything about value and growth? Because to Katie's point earlier, you do see the S&P 500 growth index really outpacing that of value for, let's say, just, you know, I guess you could say normal sized stocks now, not just the small sized ones. And so are people worried about quality right now when it comes to things that are more leveraged, maybe less profitable?
We're doing some work on growth that I think is going to be making some big waves. People think you're a value guy. What are you focused on growth? No, we're fundamentals people. Fundamental index is based on fundamentals. Can you do the same thing with growth? Turns out, yes, you can. If you choose companies based on the rate of growth, and then weight them based on the dollar magnitude of that growth, you wind up with a better growth index. And it turns out that, you know, some of these frothy growth stocks don't have spectacular 5-year earnings growth. It's pretty good, but it's not spectacular. And if you choose companies based on their underpinnings of growth, what is the 5-year growth rate in earnings, in sales, in spending on R&D? You wind up with a better growth index. But that's not where the screaming bargains are.
Right.
The screaming bargains are in non-U.S. stocks relative to U.S., non-U.S. value in particular, emerging markets value in particular, and small cap value versus large cap growth. Our work on developing capital markets expectations shows a 10-year outlook for small cap value of 8% per annum better than large cap growth.
Well, Rob, let's talk a little bit about just U.S. versus the rest of the world, because it's interesting to hear you say that that's still a bargain to go outside the U.S. Because we've seen quite an outperformance this year, and it feels like the first half of this year, people were saying this is a false dawn, it's not going to last, the U.S. is going to come back, and now you have a lot of folks saying, all right, well, I missed the rally. It seems like you're saying there's still room to run.
Oh, there's so much room to run. The room to run in large cap growth is a little doubtful. I mean, these companies have to exceed lofty expectations in order to outperform the market. And all you have to do outside of the U.S. and in U.S. small cap and U.S. value is exceed rather bleak expectations. Here's another fun factoid. I mentioned that Russell 1000 growth had earnings that were only slightly faster than Russell 1000 value over the century to date. Russell 1000 growth dividends have grown slower than Russell 1000 value dividends. So while the stocks of value have done terribly for quite a few years, the companies have done fine. Better than fine. They've done better than the growth stocks.
Speaking of waiting for value to catch up, when you pull up FTW on the Bloomberg terminal, these are factors to watch. You can see momentum outperforming much of what's out there.
Right.
I'm wondering who you could blame for the momentum. Is it the retail traders flooding the market? Is it the quant investors who are trading off the momentum? Is it the passive funds that are driving flows?
Yes, yes, and yes. All three of the above. Indexation itself has taken on a life of its own. It's half of the total market capitalization. Do a little thought experiment. Say it's 80% of the market. Index funds aren't passive. They do trade. 5% per year is the average turnover. That means they're 95% passive, 5% active. What's that active slice look like? They're buying frothy companies that are trading at lofty multiples. You don't fight it, you look for the opportunities that it creates. Because it's happening. Money's flowing in. When they have to buy a stock, it will be a frothy, high multiple company. And it'll replace a deeply out of favor, unloved company. That was the basis for our next concept. And if you go back historically, what you find is that the frothy companies then slightly underperform until they settle in to market-like valuations, and the unloved tend to bounce back. So looking for opportunities that are created by indexation can be very big. Now, thought experiment. 80% of the market is indexed. This could be the case in 8 or 10 years. That 5% turnover means 4 out of 80. For the other side of the market, it means 4 out of 20. That means that active managers have to be willing to sell 20% of what they own to the index funds, creating just stratospheric valuation spreads for the companies being added versus the companies being dropped. You can even do a thought experiment where it exceeds 100% of the plausible float, and in that case, the go-to price for the additions becomes infinite, and the go-to price for the sales becomes 0. Fascinating.
Yeah, we're going to noodle on that and so much more. You're sticking with us through the opening bell, I'm pleased to say, so don't go anywhere. We have much more coming up next. This is Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
All right, minutes away from the opening bell. Here's your setup. The S&P 500 slightly higher. Could today be another record? We'll talk through all of the action at the open coming up next. Don't go anywhere. Rob Arnott is back with us. This is Open Interest.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, we are moments away from the official start of trading on this Monday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. We know it's a consequential week when it comes to earnings. Verizon actually started off on a good note this week with a beat and raise quarter, but so did the financials last week. So did Netflix last week, and we saw the reaction there. This market has a very, very high bar. So it's all about the single stock stories this week, which is what we're going to be focused on bringing you. The bells are ringing over at the NASDAQ, over at the New York Stock Exchange. Maybe we get another record high on the S&P 500 today. Let's talk a little bit about some of the components that could get us there.
Yeah, if we get there, big tech might help. We have, of course, Tesla, Alphabet earnings later this week. Huge earnings week underway. Another big one next week, too. But Wednesday is when you see these two. Of course, they are both down on the year. But Google, Alphabet, trying to break back into green territory for the year, up about more than 1.2% at the market open. Tesla up more than 2%. Intel also up, Katie, before those earnings.
Those are the names that we need to behave this week. We'll, of course, bring you all the action there. Let's talk a little bit more about Verizon, though. It posted a surprise net loss of subscribers, but it raised its profit outlook, citing Trump's tax bill and its wireless price increases. Shares currently up about 3% or so. A reminder, we'll be speaking with the CEO at about 10:10 a.m. today. You don't want to miss that, but you don't want to miss this either. We're back with Research Affiliates Chairman and Founder Rob Arnott. And Rob, let's talk about earnings season a little bit and the reaction function that we've seen so far, because I mentioned the big banks last week posting really impressive numbers, not exactly seeing the reward. Then you saw Netflix coming out with really strong numbers, falling 5% on Friday. It seems like this market is a lot tougher than maybe it has been in seasons past.
This is what happens when you get a frothy bull market. And I'm on record suggesting that this is a bubble. Mm-hmm. Bubbles last until they don't. And so this is going to be interesting to see how it plays out. One other element that I think is really important, our CEO, Chris Brightman, has come out with a number of very interesting pieces that show that stimulus doesn't stimulate, that when it comes to fiscal stimulus, a lot of that comes back into corporate earnings. So every $1 trillion of incremental deficit spending leads to hundreds of billions of dollars of incremental corporate earnings. Just fascinating. And so the stimulus doesn't stimulate the economy. It does stimulate earnings, and it does stimulate, think of it as a fire hydrant open on a city street. The people who in the homes don't get any of the water. the people with buckets near the fire hydrants get all the water. Well, who's the people with the fire hydrants? Financial services and corporate America on the profit side.
So who benefits the most? Because you look at Verizon directly citing favorable tax reform as they increase their guidance. Are there places you're looking to see where that one big beautiful bill is going to be impacting corporate America the most?
We haven't drilled down to that. I wish I had a good answer for you on that. Broadly, it'll impact corporate earnings in a big, beautiful way, and that can keep bubbles going longer. We saw that through the whole period of monetary ease with zero interest rates, where the zero interest rates sure didn't stimulate economic growth. Economic growth was kind of sluggish that decade, but it sure stimulated capital markets. And it's not a healthy form of incremental growth if it's rewarding share prices and not the broad public. So that's the big issue. That's the big divide.
Well, let's talk about bubbles a little bit more, because I feel like we're all kind of familiar with how bubbles form. You get some stimulus stimulating the capital markets. You get investors falling in love with a theme such as AI. But how do bubbles pop? What is the typical catalyst when you look across history?
Firstly, catalysts are, by definition, a surprise.
That's true. I was hoping you could just tell us.
It's still a fun parlor game to try to guess what they can be. Second, thought experiment. What were the catalysts that caused the dot-com bubble to burst in March of 2000? I have yet to hear a really powerful argument for what it was. Maybe stock options coming up for expiration for redemption of shares, that sort of thing. But realistically, the catalyst can be almost anything. One catalyst can be earnings growing a little slower than expected. Another can be the economy faltering. Another can be a liquidity crisis in which people need access to their money. And all of a sudden, those massive inflows into index funds become massive outflows because people need access to cash. What's the most liquid asset they've got? Their index funds.
Perhaps a catalyst, too, could be the Fed chair getting fired in some manner.
Well, that's where I was going to go next also. This whole idea of the pressure that President Trump has been putting on Fed Chair Powell. You think about liquid assets, U.S. bonds being among the most liquid of them. What's the perfect hedge? Do you recommend hedges right now? And is there anything in your portfolio that suggests that your clients are flocking to them?
Well, I think one question, and you've touched on this with some of your other guests today, is what's the next move for the Fed? And realistically, historically, the natural yield on short-term money is about 1% real. Okay, so if inflation is running 2.5, that means 3.5 is the go-to rate. One of your earlier guests also said that they thought that the 10-year ought to be at 5. Well, 3.5 on short money, 5 on 10-year money is a perfectly normal yield curve. And so moving in that direction is probably where we're headed. Now, I say where we're headed because, like gravity, the movement of interest rates towards a natural rate is entirely normal. It can be forestalled by enough pressure from central control. Japan's been practicing yield curve management for a couple of decades. Look where it's got them. Their macroeconomic growth has been negligible. So it's not the right thing to do, but it's an easy thing to do.
All right, Rob, we got to leave it there. Great to see you. Always appreciate you being so generous with your time. That is Rob Arnott. He is the chairman and founder of Research Affiliates. Let's get a check on this rally right now. This stock market in general, you're taking a look at the S&P 500 up about 0.3%. And I have some good news for you, and that's that breadth looks pretty good at this exact moment. You take a look at the gainers relative to the losers in the index, more than 300 names in the green, just under 200 in the red. And it's a lot of names that you would want to see leading gains right now. Apple higher, Meta, Alphabet ahead of earnings. Then you have Broadcom and Amazon in there as well. Tesla, too, ahead of earnings. That's going to be one of the more fun reports this week. But take a look at the downside, and you could get a little bit nervous about today's action because you have NVIDIA and Microsoft trading places right now for the biggest loser on a points basis. We're talking about small moves overall, but when we're talking about trillions of dollars in market cap. Certainly those names have a big effect. So let's take a look at the sector levels and what the breakdown looks there as well. Again, more green than red. Up in the top, you have communication services. The biggest mover there is Verizon after its beat and raise quarter. The CEO coming up on open interest next hour. You take a look at the bottom, industrials, healthcare, and energy. Some of your small gainer or losers right now, Shonali.
And coming up next, we're going to talk about what you had identified a little earlier, Invesco wanting to reclassify QQQ so it could reap the benefits of one of the world's most popular ETFs. There's millions at stake for this ETF. We're going to talk about the details next. This is Bloomberg Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Mellody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg. Welcome back to Open Interest. Let's take a look at this market right now and the rally that's underway. The S&P 500 up about 0.3%. You can see a lot of strength is coming from big tech, with the NASDAQ 100 higher by about 0.5% right now. We'll see if that holds through the big earnings week that we have ahead, with Tesla and Alphabet taking the stage this week. And shout out to the small caps as well. The Russell 2000 up about 0.5%. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Dollar Tree getting upgraded to a buy over at Barclays. The firm says that it's positioned to benefit from a trade down by consumers, which will only accelerate. Next up, you have Morgan Stanley upgrading Pinterest and Etsy, citing improving macroeconomic trends. The analyst also cites Pinterest's attractive valuation. Take a look at shares right now, higher by about 2.5%. And finally, I am so excited for this. Invesco getting upgraded to a buy over at TD Cowen. The firm is calling its move to unlock fee revenue from the QQQ ETF a, quote, game-changing event. So let's discuss this news now with Bloomberg Intelligence financials analyst Neil Sipes. And Neil, I feel like this requires some explanation. So the QQQ ETF, it's actually a unit investment trust, which I swear to God is interesting. They're filing to turn it into an open-ended ETF, and that actually has huge consequences for Invesco because in its current format, Invesco doesn't actually earn any fee revenue from this enormous fund.
Yeah, and that's right. And I think that's why you mentioned the enormous fund. That's why this is such a meaningful story here. For the past 20 plus years of the fund's existence, Invesco has, charged a 20 basis point expense ratio. All those fees are effectively pass-through fees onto third parties. One caveat there is 6 basis points of that 20 goes to a marketing budget for Invesco. So they really lean on that to sort of broaden the brand of Invesco. But in terms of a management fee, advisory fee, actual top-line support, pretty much zero here. So when you talk about the fund with, I think, north of $350 billion in assets, they're looking to sort of convert this into an ETF, charging a slightly lower 18 basis point fee rate. And so we'll kind of have to see what it looks like overall. But I mean, when you run the rough math, it's obviously quite meaningful to the business. We calculate about 7% of net revenue is what they can generate if they sort of net out fees that are similar to the QQQM, which is actually sort of the clone ETF product that they rolled out about 5 years ago.
Right, that was their answer to this dynamic where, okay, QQQ is very popular and it's just growing, but we don't make any money. Let's launch sort of a baby version of it. I want to talk about the specifics of what this could mean for Invesco a little bit more because I did the napkin math, 20 basis points on $355 billion in assets. That translates into more than $700 million in annual revenue that they're missing out on. We won't know the exact revenue breakdown, how much of that goes to the index licensing, et cetera, but in terms of the boost that could give to the bottom line, just expand on your calculations a little bit more.
Yeah, and so I think when we look at QQQM, again, which is active in the marketplace as an ETF, it's about $50 billion versus the $350 billion in the unit investment trust. So when we look at that, about half of the 15 basis points is what they're netting to the top line. So if you kind of do that rough math, again, the earnings accretion is pretty meaningful here. And so I think going forward, it's going to be the question of how much do they retain some of that marketing budget. Obviously, that's going to eat into it a little bit, but it really does two things for Invesco. One, it meaningfully steps up that earnings sort of run rate as a normalized business. And it really steps up the organic growth potential, right? Because these are non-management fee earning flows that they have today. It's a product that's been growing double digits over the past probably 5 to 10 years, whatever time frame you look at. So that's going to be well received in the market. You saw it Friday with the 15% increase in the stock. In a world where traditional asset management is a little bit out of vogue, the ETFs still continue to produce the growth.
That's where I was going to go next. If you look at the stock of Invesco versus BlackRock this year, it's pretty interesting. You see it at double the pace. It's rising right now. It's up more than 15%. BlackRock is up less than 8%. BlackRock, of course, is a much bigger company. So the Qs, they've become synonymous with Invesco in a lot of ways. How important is it for them to capture this fee revenue?
I mean, I think it's pretty important, especially when you think about Invesco in the context of someone like BlackRock, where you look at the price to earnings multiples there, it's about half of BlackRock. And really the story with Invesco has been a pretty painful but necessary transition in asset management from the higher fee active products to the lower fee passive. And what we've really seen over the past 2 years with Invesco is a meaningful sort of re-rating in that organic growth. They've actually flipped to positive flows, some of the strongest in the industry. A lot of that is coming from the ETF and index franchise. So when you all of a sudden put their biggest fund and the most meaningful product that they have in the marketplace back into that franchise in terms of revenue generation, it's a meaningful story.
It's worth pointing out, too, that Invesco reports earnings tomorrow. Their call is at 9 a.m. So if you're not watching Open Interest, I would imagine that this is going to be a hot topic. Let's talk about how this actually goes through, because this is a proposal right now. They filed a proxy statement to shareholders on Thursday of last week. They're holding a special meeting on October 24th they need a quorum of more than 50% of the holders of outstanding voting shares. That is a very tall hurdle to clear when you think about how many tens of thousands of shareholders the Qs have.
Yeah, and so they may be leaning on some third parties to help garner that support. I guess two things of note. One is the QQQ as it stands today, 20 basis point expense ratio. Through this proposal, they want to reduce it to 18 basis points. So that in some worlds should generate some shareholder interest, right? When you're lowering fees, that'll usually make your shareholders smile there. So that should help generate some interest. But, you know, I think we know that the QQQ has a pretty sizable retail investor holding as well. So sort of garnering the support of a lot of smaller retail investors, you may sort of need a lot of outreach and maybe need some third-party support there. But again, I think, you know, over time, we'll certainly be watching this. It's sort of a unique story in the space right now. We'll have to see if others follow suit and sort of follow how this proceeds, but certainly if it goes through, it's definitely a net positive.
Yeah, absolutely. It'll be fascinating to see how this one develops. I do want to pull up that table once again, the most profitable ETF. So it's ironic that the Qs are at the top and Invesco doesn't actually see much of that profit. You also have SPY up there as well, which is fascinating because this is in the same situation as the Qs. This is a unit investment trust, meaning that State Street itself doesn't really see much of that $577 million in annual fee revenue. Neil, I know you don't cover State Street, so I won't ask you about it, but really great insight here. Stay close. That is Neil Sipes of Bloomberg Intelligence. And don't miss ETF IQ today at noon right here on Bloomberg Television. State Street's Anna Paglia and Double Line's Jeffrey Sherman join the show. Now coming up, Figma and some of its investors are seeking to raise over $1 billion in an IPO. We'll bring you the details here next. This is Open Interest.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Welcome back to Open Interest. Let's get a check on this rally because we have gains extending right now. If you take a look at the S&P 500, now higher by about 0.4%. We are above 6,300 on that index. And you have big tech really leading the way with the NASDAQ 100 higher by about 0.6%. We know that it is a busy week when it comes to earnings. A lot of big tech names reporting. You take a look at what has reported so far. To my left here, you had Domino's earlier this morning. It was higher, now it's lower. Verizon really holding on to its gains right now. And then you have some of the big tech names. Tesla up on the earnings stage. It's higher right now too, but it's coming up this week, and we'll see if it follows the path of Stellantis, which was reporting some pretty hefty charges when it comes to some of those tariff impacts. Shonali.
Yeah, and in other news, we have IPO news coming as well. So companies not yet hitting the New York Stock Exchange or NYSE, but pretty close. Figma is one of them. The company and some of their investors are looking to raise just over $1 billion in an initial public offering. The software company has filed for a listing, which could see it valued at close to $13.6 billion. For more, we're joined by Bloomberg Equities Capital Markets reporter Anthony Hughes, and that $13.6 billion valuation is below the $20 billion that it could have gotten in a sale to Adobe. What does this say about valuations for the darlings that are about to hit the market?
Yeah, well, I think it's interesting because once you add in restricted stock units and options, and the equivalent of options and the like, the valuation will be a bit higher than that, more like 16 billion, 16.5 billion. And I think over the next week or so, as the roadshow goes on, and this is the deal that's going to be pricing next week, next Wednesday, July 30. There's going to be likely to be a lot of demand because this is a fairly scarce asset in a company that's growing 40% plus. The software sector hasn't been as busy in the last few years as it was in, say, 21. So the situation we have here is that this is somewhat of this is a big event for the software industry in the sense because this is an application software company that's going public, and there hasn't been very many of them in recent years, and this is going to be getting a pretty sporty valuation. Some of the software IPOs that we've seen in recent years have come at more like sort of around 10 times sales, whereas this one's going to be leaning a bit more on the valuation. And I think, even though these numbers we're throwing around today are based on the terms that they've launched this morning, I think, it could expand over the next week. Certainly the company will be hoping so.
So circle that date on your calendar, next Wednesday, July 30th. It's interesting to see just the pace pick up this summer. There's been no summer slump when it comes to the IPO market, and I still don't have a good sense of what is driving that. Is that we're past peak uncertainty? Is it just that traders and companies are tired of waiting so long to come out of that pipeline?
Yeah, well, it's been an interesting year in terms of the narrative for the IPO market because while it's been a fairly positive environment, we've seen some really strong outcomes, some strong debuts, particularly Circle, which was early last month. But we did have a big gap there in April where there were no IPOs, and we've had these disruptions associated with the spikes in volatility around the tariffs and the like. But overall, the environment's been very strong, and when IPOs have come to the market, the IPOs that have come have been quite well received and heavily oversubscribed. And I think people are generally positive about the outlook, particularly after Labor Day. But normally the summer can slow down a bit. But here we've got a bit of a flurry of deals that's going to happen between, say, now and maybe the next 3 weeks, and then we'll have a break for August. But we're going to have 4 companies go public this week, 4 sizable companies, and then next week we'll have Figma, and we'll have another one too, so another one or two maybe.
Also, Katie, bullish that crypto exchange has also filed a lot of SPACs as well. So this is a market that is absorbing this while it can.
I'm glad you defined it because I was going to say, didn't you just launch the show and
I know.
Going public as well?
I know, different going public.
Yeah, true. Anthony, great reporting. You're going to be very busy over the next week or so. That is Anthony Hughes of Bloomberg. And coming up in the next hour, we're joined by BlackRock's Gargi Chowdhury. She will be talking to us about earnings expectations, and then really excited too for our conversation with the CEO of Verizon.
Yeah, we'll also speak to Senator David McCormick after that big AI summit in Pennsylvania. Stick with us. This is Bloomberg Open Interest.